And welcome on this beautiful day in Sydney to the third in our series of webinars on looking for growth outside Australia. So what we've covered in the previous two sessions has been the opportunities that listed markets outside the mainstream Mag 7 context offer. So we looked at Japan, we looked at listed infrastructure, we looked at emerging markets, we looked at SMIDs. And so those are opportunities to achieve growth goals within a portfolio from the listed market. But today we're going to be looking at unlisted markets and private equity for growth opportunities. In a moment, I'll hand over to Jason Petras, our host for the three series. But just before I do that, let me remind you that in October, we'll be hosting Independent Thought in Melbourne and in Sydney. In Sydney, we'll have Alan Kirkland, Commissioner from ASIC, talking about ASIC and its thinking around the managed account space. Alan will do a brief presentation, and then he and I will have a conversation about the impact of, or their thinking as expressed in the corporate plan on corporate governance, management of conflicts, and outcomes for consumers insofar as managed accounts deliver those or are affected by those three issues. We welcome questions, and we've had some excellent questions through the last couple of days, but of course, we welcome your questions today. So now it's my pleasure to hand over to Jason Petras to take us away on this third session on private markets. Thanks, Jason.
Excellent. Thanks, Toby. So welcome back, everybody. So obviously our last session of the three, and yeah, don't want to hold people up too long, being such a nice day outside. So we'll sort of get into things. And today, with private equity being the focus, we're coming at, I guess, the discussion from two different angles. And the presenters are, I guess, providing a little bit more of a context around the way that they're providing, I guess, solutions, and also, a little bit of chat about the delivery and infrastructure as well. So the first presenter is going to be Kieran from Centric. So Kieran Canavan, who's the CEO there. And he's going to be discussing more about the whole of portfolio within a private equity solution, covering the platform as well, looking at how they approach liquidity and governance, pricing, and the overall implementation of really an on-platform complete solution, which does bring in, obviously, with private equity and some of that liquidity, there's challenges as obviously the benefits are there, but there's also challenges that sort of need to be addressed given the complexity. So Kieran will touch on that, and then the second presenter is going to be Adam Mize from Pengana. And I'm sure you're all familiar with Pengana as a fund manager and the range of products they have. So Pengana has recently brought a vehicle to the market, which has got some quite unique characteristics, and I think provides a different differentiated approach in the way they're solving again for some of those liquidity and diversification type needs within the private equity space. So and he'll be discussing a little bit around vintages, secondaries, and the way that the underlying managers are doing their job. So what I wanted to do is just give a quick, I guess, overview on private equity, just touch a little bit on some of these key areas. Now, hopefully everybody on the session has got some pretty good background on private equity, but just as a very quick refresh, because I know a lot of acronyms get thrown around. There's a lot of information out there. I just sort of wanted to break down some of the basics within private equity and how it differs. So just the first slide here is just looking at that life cycle, and this is really a life cycle and sort of very driven within the PE by, I guess, the typical longer term investment process, and also then what's traditionally been a longer lockup period to go into your sort of company acquisition and then out of. So you have your general partners, which are effectively the groups that are the fund managers and those that are actually building the portfolio of underlying funds. And they're raising capital from your limited partners, so your LP. So you hear that GP and LP a lot thrown around in private equity, and I just wanted to reiterate what that was again. So your GPs are working very closely with your underlying portfolio of companies, and their job is to really identify, obviously, or acquire up companies that they think that they can add value to and improve over time. So that can include them getting involved in strategic guidance, operational support, additional capital injections, but just overall trying to work closely with the company and make them realise that value. GPs are also managing the overall day-to-day operations of the fund itself, across sort of performance, the valuation, which we'll talk about in a minute, capital calls, reporting, and sort of everything that you sort of have on that administration side of things. And then ultimately your LPs, who are the ones that are the sort of beneficial owners of the funds. Ultimately they're looking for an exit from post that capital raising. Now, in a lot of cases, traditional private equity was sort of over a time frame of 10 years, and we now know that we're given the way that the sector has really started to get bigger and provide more liquidity options in the secondary market. Obviously, there's opportunities there to move in and out of that exposure, not necessarily having to be locked up for 10 years. So that's now coming through a range of not just IPO, sale, recapitalizations, but also that secondary market. So and that's where that value realization comes in. So hopefully that gives you a bit of an idea of that life cycle and where the different moving parts play into it. So if we just go to the next slide. So just to put things in context around, we hear a lot about relative sizes, and so this is data from sort of towards the end of 2024, and it just sort of puts things in context a bit that there's roughly, and this is I think predominantly, I'm pretty sure it was US data, but there's roughly 25 times more private companies than there are public companies. So obviously there's a much larger universe. However, the actual size of the market in the traditional sense of private equity, in the public space, it's around about 87 trillion, whereas in private it's around about 11. So it's only, in reality, the actual size of the private equity market is really close to sort of 12% of the actual listed public market. So I think that's just important to keep in size, that we do have the perception that private equity is very big. But it's not nearly as big as that listed space. So and that obviously can, in terms of where money's going and the raising and the opportunity set, is potentially not a saturation point, at least anyway. So and just onto the next slide there, please. So looking at that in terms of a dry powder. So the dry powder term is really effectively the money that private equity have sitting on the sidelines right now that they're looking to deploy. And you can see these numbers, they're quite big. So sort of sitting around there about 2.5 trillion. So this is a combination of, the fundraising and what they've had sitting there looking for opportunities. So you can see that's been growing, obviously in line with the growth of the sector, and money looking to be deployed in there. But after quite a long period, sort of all the way through the sort of back to 2012, we've had that increasing, war chest there of money to be spent up until 2023, and we've seen now into 2024 that money is now starting to move and be deployed more actively into new opportunities. So I think that's quite a healthy sign for the sector overall, and shows that things are sort of coming back to life a little bit. So and then just on valuations, because I know that the value, just on the next slide, thanks. The valuation gap is talked about quite a lot. And we have seen that's blown out. You saw there in sort of 20 and then into 2022 as well, that valuation gap has sort of moved around quite a bit, and sort of got questionable in terms of whether that was the private equity valuations being, I guess, marked and reflected, properly. But you can see from this chart that spread has really started to widen out relative to the public markets, and now that may be a function or a combination therein of the fact that public markets are maybe now pushing into stretch valuation, and when you're looking at things on a sort of valuations on a Mag 7 basis, that there is stretch valuations, particularly in the US, and I think we saw in the very first session talking about international equities, particularly in the large cap space, that we are seeing a very, very stretched valuation level, and the forward on those is potentially challenging. So that rolling into I think at least a pause of thought on the opportunity set again is quite interesting. And then I think that was my last slide. I think. Oh, no, one more, sorry. And then just to talk about, deal volumes, again, we hear a lot about, and I know Adam and Kieran are both going to talk about the secondary market in their pieces, but you can see there that growth of the secondary market, and what we're talking about there is effectively, there's not an exit per se in terms of the pure exit where the private equity company is being listed or turned into or being acquired by a third party, but it's actually being traded in a secondary market between two GPs or between two private equity entities. So that market is getting bigger and bigger, and I think that liquidity is actually like a good thing as long as it's done in a sensible way with proper transparency. So hopefully that gives you a bit of context as where we're at in the I guess evolution of things at the moment, gives you some scope around the size of the market and sort of where those valuations are. So I'm going to hand over to Kieran, who's going to take you through Centric's approach and the way that they think about the space. I think you'll find it really, really quite interesting. So over to you, Kieran.
Thank you so much. Thanks, Jason. I'm going to now try and prove that I can work with technology by sharing my screen with some slides. So bear with me for 1 second. Hopefully you don't get to see a picture of yourself. Can I just check that slide deck come up, Jason?
That's up now, yeah.
Okay, that's great. Thank you, everyone, for the opportunity. And look, this is such a huge asset class to cover. So I'm going to just try and cover small little parts of it, but maybe some interesting parts, and try and put some things in here that I think are really worth considering if you're going to be going into the asset class, and some learnings that we've had as we've been working into this asset class. So at a very high level, just contextually, we would look at a private equity. It's equity of ownership of non-public companies with an active plan to create value and exit at some stage. For us, the reason we look at this is long-term performance that can be compounded over long investment horizons, so capital growth. And then the other thing that's important for us is access to secular growth. So that's, multi-year above GDP expansion driven by long-lasting forces, whether that's technology, demographics, whatever it is, but not driven by the business cycle. So through, multiple business cycles. Some of the key themes that we've seen in private equity that play out now, really in the last several years, PE hasn't delivered on its general promises, when it comes to, funds finishing up, delivering the outcomes that they wanted to deliver. Some of that's not the fund's fault. Some of that is got to do with COVID, interest rates going up with inflation, equity markets, listing there, they've really shut down over the last several years. So there are reasons for that, but in general, if you've been in these funds, you probably haven't had what you've expected. Private companies are also becoming, another point for us is private companies are becoming much larger and they're staying private for longer. So accessing these private companies is becoming critical, whether you're going to put it in an alts allocation or whether you're actually going to put it in an equity allocation, a global equity allocation. The other thing that's a learning through this, and I think it's a learning for certain types of these funds as well, don't ignore the macro environment. So where you can, you still need to be able to tactically risk manage. COVID proved that. interest rates, and if you look at how a lot of these funds were affected in write-downs in 2022, I mean, it happened through S&P 500 and that as well, with interest rates increasing. You still need to be able to tactically move if you possibly can at an SIA level. And then, from our point of view, also highly capable and successful managers and structures are required to access across, late stage and early stage private equity. The next point just to run through is really the equity, the ecosystem and what we see. So this is super high level. I think Adam's probably going to give you a bit more detail on that.
Kieran, are you? We're not seeing your slides move on.
I'm just doing the intro first.
Right.
The slides.
Okay.
I've only got a couple of slides, and they're more about the examples. So
okay,
that's fine. So sorry, everyone. You're seeing just the first slide there because I haven't moved them on yet. So just really quickly, the ecosystem for us and how we classify them. We look at the typical PE funds and we'd classify them normally in alts, and that's normally where you have longer term 10-year plus a couple of extensions potentially. You have a J curve in there, you have various vintages over time, that would incorporate VC, buyout funds, special situations, distressed. And then we go and we have a look at some of the evergreen PE funds. There's a lot of different structures in there, secondaries and follow-ons. And that, some of those will either become closed-ended or they will potentially get into an evergreen structure. And then the last two that are really important for us, which is our preference to access these markets, would be crossover funds, and then also the co-invest alongside PE funds. So some of the key themes for us, just running through this, and don't worry, the slides will start moving shortly. I think everyone loves PE, but they hate the price. And if you think about it, the key example is you can be sitting on an airplane in a seat next to and have people on either side. You don't know what price they've paid for their ticket. They don't know what price you've paid. But the likelihood is you haven't all paid the same price. So, that's really important for us, and a key bit of work that we've done over the last several years is trying to work out how do we pay the same price as, whether you're going to be looking at the sovereign wealth funds, massive pension plans, insurance companies, etc. How do we get to that price level? What do they do? And I'll cover that in one of these examples. The other one, which I think is super critical, is the secondaries market is becoming more legitimate now. And if you think at equities, I think the more recent number on listed equity, the secondary market is 127 trillion. So it's significantly larger than the primary market there, but secondaries in PE is more nascent. And sometimes when you see the deals that come through, I felt, like a buyer of last resort sometimes, because these deals are not equal. So it's really important to look through at the secondaries. We're seeing some really, really good follow-on funds, though. The key there is, why the GP's doing it. And if they're doing it because there is a phenomenal asset and they want to keep holding that asset and they get the right structures and they don't discount too much, that's a really good thing. But also be aware that there's a lot that come with really bad assets. Which, that it's been in a fund, it's the last asset in the fund and they can't get rid of it. And then they're getting it out there and they don't sell it at enough of a discount. So I'm going to start moving the slides along now. I just wanted to give you a very quick sense of, if we say the two access points that we really like are co-invest and the crossovers. So I'm just going to give you a sense. This is actual portfolios that we've used or do use at the moment. I've taken the fund manager's name out, but it's probably not too hard to guess who it is. This is a crossover fund. And we really like the crossover type strategy if it's done well, because it gives an ability to access the privates, normally late stage privates, and it gives the access then to publics as well. So there is more liquidity in these types of structures. And if the manager does it really well, they will only go into the privates if they can get a better return than on the publics. So, when we look at these sorts of things, and then if you look at some of the names there, you can also see why I'm saying some of the private companies, especially the later stage ones, are in actual fact much bigger than what we were used to seeing in some of these sorts of funds. You got OpenAI, I think the last transaction's going through now, which is a a secondary transaction of about 500 million. You've got Revolut there, it's doing a transaction at 75 billion. Databricks, I think, was 100 billion. Scale sold to Meta about a month and a bit ago at 30 billion. So these are big privates. So we like the fact that you can get these sorts, and this gives you a sense of what these look like when you've got private and public. One of the main reasons that we really like it as well is if you go in on the private side, if you have a look at what's on this page, when you go from private, when it goes to public, there is absolutely a lot of value that's created, but immense value is created after that fact. But there can also be risk that comes at the same time. So if you've got a really good manager, it's not that you've been forced to sell out and take the money off the table. You're actually getting the ability to stay in and capture that further upside post IPO, or to move out completely at IPO. And if it was going to be a risky IPO. So crossover we really like. There are only a handful of these that we've found that are really good, but they are out there. The other one, and this is probably worth sort of mentioning, this is a lot of work's gone and does go into this. What we've always wanted to try and do is get to the same as what the really big sovereign wealth funds, the pension plans like CalPERS, Texas Teachers, what these guys do, and this comes to the price point not being at parity with various investors. What you will see all of these really large investors do, they will put money with GPs, and they will get the GP at 2 and 20, and then the GP, often at a 1-to-1, they will give them co-invest deals. So you can build up a portfolio that looks exactly the same as what you got in the fund, or predominantly the same as what you got in the fund, and you can then take that at a 0 fee rate on the GP, and then that brings it in. So that's a structure that we use. We really like that structure, to give you a sense. To run that sort of structure, if you just run a co-invest portfolio, you can run those structures at about 1 in 10. And that includes running an Australian feeder into that. Is substantially different what you see in some of the others. Also, if you run co-invest portfolios, you actually have the ability to get the diversification, not just from the individual investments, which you will have, but you'll have diversification across the co-invest, the managers, the GPs. You'll have vintage diversification. You can get the J curve out, etc. So that's our preferred access points. And really, that's where I'm going to stop on those slides. So really, that was just to give you a bit of a sense of some of the things that we look at. So I might stop sharing the slides now, if I can get to do that. And I think, Adam, you're going to come on now. So I'll just go back onto mute.
Thanks, Kieran. Yeah, but that's really very interesting, actually. And I think it just goes to show there's a lot of different ways to, I guess, build portfolios within the space, and also managing that access to secondary markets, co-investors. There's a lot of ways you can get exposure, and I think I think what people are sort of seeing more broadly now is there's good ways and potentially bad ways to do it, and there's also transparent ways to do it. I think one example that I've seen probably at the pointy end of where directly trying to get an allocation into, I guess, the private equity spaces. There's a vehicle in the US called Destiny X. It holds a reasonable amount of SpaceX, but it's a free. It basically works like an LIC equivalent. And that was listed with a lot of fanfare in the US. And at one stage, I think it was trading. I'm not sure if you're familiar with this one, Adam, but it was trading at something like 10 times the implied value of what SpaceX had traded on its last round. And people were piling into this thing thinking they were getting SpaceX, and then the whole thing just collapsed, and they lost like sort of 80 to 90% of their money. It's still trading. I think it's settled around about a 2 or 3 times premium, but it just gives you an idea of you've got to be aware, and having like a layer of actual genuine transparency and professional management on these deals is really critical to make sure you're getting the right valuation. So sorry, that was just a bit of a side note I thought I'd mention. Adam, I know you've got a few things you'd like to show to us about the PE1 fund, and also just some general views on the space. So over to you.
Thank you. And just to let everyone know that there was obviously a little bit of confusion between Jason and I thought that this was all going to be a Q&A conversation. So while Kieran has been speaking, I've been throwing a few slides together, so it might not be the most coherent presentation you have ever seen. Also want to just clarify, PE1 isn't a new vehicle. It was brought to market in 2019, and I'll talk a little bit about our reasons for doing that shortly. I also want to touch a little bit on something that both Kieran and Jason have spoken about, and that is that the last couple of years have been pretty tough for private equity. The industry has had to adjust as interest rate increases and valuations have compressed. And because private equity is slow moving by its nature, these adjustments have taken time to work through the system. I think that we've also been dealing with very negative sentiment, in part, quite rightly, because people have been concerned about the deals that were done during the COVID period when rates were low, when valuations were high, and when the system was really awash with cash. But we are now starting to see a very definite improvement. Deal activity and distributions, which are often seen as gauges of industry health, are both trending higher. In fact, distributions across the industry as a whole are now running ahead of contributions for the first time in, well, certainly since 2021. So the industry on a net basis is returning capital. Jason showed that slide on dry powder, so the amount of cash sitting in PE vehicles that hasn't yet been deployed. And it is high in absolute levels, but I think that what is important to consider is that dry powder number on a relative basis. So if you divide dry powder by the total PE AUM, you will see that it's actually at a multi-year low. So in general, we are talking about a far healthier environment for private equity. So what I've been talking about there are largely averages. And obviously, there are going to be, better segments and worse segments, better managers, worse managers, strategies, etc. There's going to be differentiation and variation with all of that. So our product PE1, it's an ASX listed vehicle that provides holistic exposure. We're targeting the top quartile of private equity exposure, very, very diversified across the different implementation methods, etc. So it's managed by a firm called GCM Grosvenor. Kieran may speak about them as well because they look after some of the stuff for him as well. And I think that if we look at the distributions that have been realized across their platform, over, I think the last numbers that I saw year on year were 60% up, which is certainly indicating that the kind of strategy that is employed across their business and by implication in PE1, our fund, is certainly well past the tipping point. So things are looking up. For us, the sweet spot remains mid-market, which is much less reliant on IPO conditions because there are multiple exit options, so it naturally rebounds a lot quicker. But I still, my mantra is actually always diversification. Don't take massive individual bets. PE has historically outperformed over the longer term, and there are very good reasons that we expect it to continue to do so. but to have a better chance of capturing sort of the very favorable long-term risk-adjusted returns, we do suggest a diversified portfolio. So I'm quickly now going to, if I can find it, I'm going to share a few slides of things that I think are generally interesting. Can you confirm, somebody confirm that you can see the slide that I shared, declining persistence?
Not yet, Adam. No.
You can't. Okay, let me try.
Big green button at the bottom. Big green button at the bottom for share.
Yeah, I did think that I was sharing it.
Yep.
Can you see it now?
It's coming now. Yep. Perfect.
Okay, great. So as I said, wasn't prepared, but I'm sharing a few slides that I thought was useful. We all know what it says in the disclaimer, that past performance isn't indicative of future performance, but no matter what the asset class is, the first thing we do when we are considering a manager, regardless of the asset class, is we look at past performance. We all naturally assume persistence, which refers to the tendency of an investment strategy or a manager to consistently deliver the same or similar performance through time. Now, in PE, returns used to be persistent. There were fewer good managers, there wasn't as much capital, markets were less competitive, and the best managers sort of outperformed fund after fund, vintage after vintage. But this persistence has declined to the point that returns are now basically random. A fund that was top quartile is as likely to be followed by a fund that is in the fourth quartile as a fund that is, top quartile again. So next time you have a sort of a salesperson in your office spruiking their latest fund, and they show you past performance, take it with a pinch of salt. There isn't any real advantage associated with a stellar track record in the previous strategy. Just wanting to see what the next slide is. Okay, great. So if past performance doesn't make a difference, doesn't help us to identify future outperformance, what should we be looking for? And I guess this is where it's really useful to align yourself with a skilled allocator who sees the breadth of what is being offered and can perform DD and rank managers on forward-looking factors, because this can really help to understand the appropriateness and the suitability of a team, a strategy for the current environment. And you've got to consider there are so many little clues that need to be considered about the strategy, about the team, how are interests aligned, how are risks managed, is there a deployment pattern that is suitable in the current environment, how are regulatory challenges managed. And what you need to do is you need to piece these clues together, and that gives you greater conviction in the likelihood of success from choosing different managers. And of course, no matter how much DD you do, you can always get things wrong. And so I come back to the importance of diversification. So we've heard a little bit about primaries, secondaries, co-investments. I'm not going to go into it. I think that is something that has been dealt with in a fair amount of detail. But what I want to say is that it's important to have access to all of these implementation methods. You don't want to just have to just have one, because then you are going to get a lopsided portfolio. You're not going to get the full benefits of diversification. PE1, I'm just going to go back a second if I can. Can't, so I won't. PE1 invests in all of those different implementation methods. So when we put PE1 together, why did we do it? We did it because we wanted to give investors an opportunity to access an asset class that has historically been extremely difficult to for individual investors to get the breadth of the access. Okay. You can always get exposure to a particular manager, but how easy is it to get exposure to a private equity program that will deliver diversification through all of those different implementation methods, etc.? So when we were thinking about putting PE1 together and bringing private equity to the broad, the broad investment universe, there were obviously a number of options there that we could consider. The first option was obviously the convenience of a solution where the complexity of selecting and accessing funds, of constructing the portfolio, of capital management, all of those things were contained in a single vehicle, because that's what retail investors really need. And then the second consideration was liquidity. And obviously, there's a lot of convenience, particularly in a managed account environment, of being able to allocate consistently. So an open-ended strategy on the way in is very, very useful, but actually on the way out, you need to make sure that you can get your money back as well. And so we considered the range of products. We considered your funds with quarterly liquidity or monthly liquidity or gates. But when the liquidity that these structures offer doesn't match the liquidity of the underlying assets, then the manager, and by extension, each individual investor, is relying on the behavior of all other investors to basically provide reliable liquidity. But we know that there will always be periods when this behavior can't be relied on. And that's because all investors during times of crisis tend to behave in the same way, and that's when the gates will close. And that's typically when you need liquidity most, because the rest of your portfolio is also blowing up. And we think that is when real value is destroyed. And that's why we like a permanent capital vehicle listed on the ASX, because it does away with that liquidity mismatch. We know that there are no perfect solutions, that discounts have to be managed. PE1 is currently trading at a discount. A selling overhang developed when I managed to go backwards. A selling overhang developed when the market was going through that adjustment period, and we've been left with sort of a permanent trading at a permanent discount. So what we have done is we've announced a permanent on-market buyback program. As long as the units are trading at a discount, we'll use the majority of the cash that comes back from the portfolio, that comes back from the realizations and the distributions, which, as I've said, are already ticking up, to buy back units. The bigger the discount, the more we will buy back. This will obviously be accretive to investors, because you're buying back, and the accretion is the discount accretes to the NAV. So we're really backing ourselves that we will manage the discount, or the vehicle will effectively shrink down to nothing. Since we've been doing this, the unit price has risen by about 15% over the last few months. So we think it's working. We think it's worth looking at. And the other thing to consider is that PE typically doesn't pay a yield. PE1 pays a 4% distribution yield at NAV, so discount currently at a discount of probably almost 20% still. That is, that discount, that yield is larger because of the discount, so you get paid while you wait. I guess that for somebody who didn't prepare a presentation, that's what I've got at the moment. Apologies if it was a little bit disorganized.
No, that's great, Adam. No, I thought it was a really good point. So, and apologies for the new vehicle comment. So for that one. So, but I think it is actually worth highlighting on that the underlying manager Grosvenor, they've been around for a very long time, correct? And been doing this for a long time. So, maybe you just want to touch on that quickly.
Yeah, so Grosvenor have been doing this since the late 80s, early 90s, I think. I can't remember the exact date.
1971 they started.
But
54 years.
Did they start in PE in 1971?
Yep, well, they had hedge funds they started in 71, and then PE was a bit after that.
Yeah, so PE was
been around.
A little bit later, but it's very well. Grosvenor is one of the largest independent allocators to PE globally, and the fact that they see everything makes an enormous difference, because then you can really get the ranking. How do you know what you want to do the due diligence on? How do you know what warrants a deeper look if you are not seeing the full breadth of the market offerings?
Yeah, I think that's a key part of the space, and I mean it's sort of you compare it to people sort of sometimes just want to make these very clean comparisons between private and public markets, but just like with a public market, you've got this huge universe. It's exactly the same with a PE. So any manager you want to have, obviously, you wouldn't go into an equity manager and say, well, you're limited to 10 stocks, right? So that's got a lot to do with the value add. So thanks both for the presentations there. So I've just got a few questions we'll just sort of run through. So we've got about sort of 15 minutes left. So we'll just go through a couple of these and really keen to get your views on things. So I'll start with Adam. So I think the endowment and pension parallel comes up a lot. You hear it in so many conferences and presentations that this is how Harvard allocate, this is how CalPERS allocate. This is why you should be going down that route. And it's always future fund, and even within our space in the industry funds here in Australia. The one of the big differentiators for us though, and most people that are going to be listening to this today, is that we're dealing broadly managed account world. So we're dealing in platform world. We don't have some of the I guess the luxuries that they do. So really, if you look at it from say an SMSF holder, like management trustee managing $2 million, and they're coming into their drawdown phase or just hit that. What do you think is actually a realistic and a sensible allocation into private equity, in a general sense? And then, what sort of other considerations, Adam, should people that are doing that be looking for around the way that they're actually allocating that money into that private equity piece?
I think that's a really great question. And I'm not sure that I have a very complete answer, especially considering the points that you made about some of the structural requirements for holding assets in managed accounts. But I do have a few thoughts that I'm happy to share. I think that the industry is still very focused on a modern portfolio theory type approach where we seek to maximize returns for a level of risk, and that's great during the accumulation stage. But as an investor moves towards decumulation, the objectives will start to shift. So now, what do we really have to focus? We have to focus on ensuring that liabilities are met, that the retiree has enough money to live on, and that the money doesn't run out. And of course, this has become significantly more complex, because we may be at a tipping point of much longer lifespans as well. How does this relate to PE? PE is self-liquidating. The PE managers sell down assets in the portfolio at the optimal time on an asset-by-asset basis. That's great for retirees because it leads to better returns, and it also contributes to lower volatility and lower correlations. The reason for the lower volatility and the lower correlations is that the committed capital allows a PE manager to buy when everyone else is selling and sell when everyone else is buying. So I guess, a long answer, since I'm not going to give you a number, but I'm willing to bet that when you think about things with an asset liability mindset, the number is considerably bigger than we probably intuitively think. I mean, Kieran, you are more involved in portfolios in drawdown phases, so I don't know if you agree with that.
Yeah, I can just give you a quick view. I mean, really, it depends how the portfolio is constructed, but I agree. We look at, and we'll use Grosvenor as well, and we want to run portfolios that are exactly like CalPERS. We want to sit at the same price as CalPERS, and we do. We sit at exactly the same price. We see the same investments, etc. They will run without holding cash or anything like that. They will run at 5% per quarter, liquidity. So that, I think, is actually quite appropriate for someone in drawdown phase, depending on the other assets they have. So you got to look at how the other assets are there. So we would see private assets, whether they're late stage or early stage. We don't like the J curve that much in there, and blind pools, all of those sorts of things. But so if you get the structure right, so we would want a MOIC of somewhere around about that sort of 3 to 3.5. If you're getting that right, we would see at least 10 to 15% in someone that's got a balanced type portfolio.
Okay. Thanks, Kieran. Yeah, I was going to roll that question into you as well and sort of say, and you're obviously coming up from a slightly different angle and actually quite a privileged position in terms of sort of seeing things across platform, across portfolios. So yeah, I mean, PE living within an SAA, and I guess I'm going to roll that and extend that out to a further question around, obviously, yes, it's a growth asset, but are you looking at that as an alternative growth? Is it
Good
sitting
question.
within the equity, international equity? How do you view that world?
Yeah, so it's not a super simple answer, but if you just go back to SAA and how you construct SAA, one of your key starting points is deciding on your asset classes, deciding on your capital market assumptions. So, and those are super critical. So it depends how you define those. But typically, if we use multi-asset, and we would have global equities, and then you'd have alts. What we would tend to do is global equities, you'd use a MSCI equity benchmark. What we would find is some of the later stage privates would actually sit in there because they do fit in there. They've got the size of them, the liquidity of them, all of those things fit quite nicely in there. The early stage co-investments, PE, tend to sit in alts mainly because of liquidity constraints, etc. And with our CMAs on SAA, we would use custom ones in the alt space, because alts typically we would run we would run infrastructure in there, opportunistic, and PE. And to get the right, if you're going to do an optimization on SAA, you've got to be really certain that your CMAs are actually correct, because if they're not, it's just going to give you the incorrect optimization. But we run very bespoke portfolios for very large family offices and things like that. They would sit at about 40% alts because they can handle the liquidity that's in there. Our retail clients, we would sit probably around the 15 to 20% alts. So very, very different allocation, because the structures just don't work, especially on IDPS. IDPS is actually a bit better, somewhat easier to work with, but most certainly don't work too well unless you're using a managed discretionary account. So a managed account is somewhat problematic, especially if you want to run both types of portfolios on IDPS and public office super, because public office super has a lot of constraints. We do manage to do that, though. You can do that if you construct the product right. And if you look at what Adam and them have done, that product is constructed right. It actually can give you that access in public office super.
Yeah. So it's perfect timing because somebody actually just asked the question: are MDAs better for a PE compared to an SMA? But I think you just answered that.
They're different. It depends what you want to do. And I'm saying our preference. I'm not saying which is better and which is not. Our strong preference is to have as many tools to hand as possible.
Yep.
And for that, we also like a pure play. So if you want to sit pari passu, with a sovereign wealth fund or a pension plan, you are going to have an MDA. It's going to be much harder not having an MDA. And really, you're going to be to a large extent, you'll be outside of the public office super. So you can still run it on IDPS. A lot of platforms nowadays are becoming incredibly good at sort of doing the non-custody piece, but a long way to go on the custody piece. So even on platforms, it's still really tough, even if you're just on the IDPS side.
Yeah. Okay. Thanks. So look, I've only got about 5 more minutes, but I think this is a really good question to ask. Particularly for the advisors. My conversations with advisors and our clients. It's really, if you put yourself in their shoes and you're sitting there talking to, whether it's platforms, whether it's asset consultants, whether it's actual fund managers, what for Adam and Kieran, what are the, let's say 2 or 3 key things you feel you should be asking questions about when you're looking at allocating into this space? Because I think it's one of the areas that a lot of people aren't. We hear there's a lot of stuff gets thrown around, and there's a lot of concern. But how and to sort of start off, our general opinion with this is that there are genuine benefits within the space. There is also an illiquidity premium, and you've got to make sure that what you're allocating to and the potential, perception of increased liquidity that you may be getting through whatever structure or vehicle isn't being eroded away by adding complexity where it's either unnecessary or excessive. So for us, there's absolutely benefits to it. It's just you've just got to ask the questions about how it's being done and how that that solution or that engineering around the access has been performed. And I think also that there's sort of, I guess, the bigger question of do I necessarily need the liquidity that I think I want to have it, but do I actually, does it really need to be there, and am I taking it away? So yeah, Kieran, start with yourself on that. But yeah, the couple of big things. So
that is an incredibly detailed question. So I'll just throw out 1 or 2 things that I would say to an advisor to understand. 1, it is a complex area. 2, it works incredibly well. There's an illiquidity premium, but genuinely you can do it. Works in portfolio construction, SAA, TAA incredibly well. However, the things I would look at, 1 is the cost. You've got to get the cost right. You've got to understand what it is you're paying for. 2 is look at the liquidity structures. There's always a cost for liquidity. So understand what that is, and if you're happy to pay it, that's fine. Big lessons through the GFC for anyone that was in vehicles that had a mix of liquid and illiquid, or variously liquid, is that if people run for the doors, the product will close, even if it's a price close. But what can also happen is you can get, if the fund is not managed extremely well, which is one of the reasons I personally do not like some of the fund structures, especially unitized structures, because it's in an omnibus structure. If a big investor moves out, typically what happens is the fund manager sells the liquid or the easy to sell assets. Whoever's left, and that was in the GFC, you were left, you thought you had something that was liquid or would run for 2 years, and you ended up 15 years later still holding it. So that's what I would say. Just, do that. Use people that are reputable, but if you start looking through, make sure you understand it as well. I think from an advisor's perspective, don't let someone tell you it's complex, you won't understand it. Really look through it. Valuations are really important as well. Timelines. If you're buying into secondaries, I'll give you 1 real hint for secondaries, if I can do that, and then I'll finish. If you're going to look at secondaries, look that they've got was something called the LPAC. The LPAC is a limited partner advisory committee that will manage the process. So it's other LPs that is sitting with the GP to manage that process. So there's independent valuations, competitive market price checks, clear architecture that you can understand, aligned economics, and carried over investor protections. So that's one, because we are seeing more secondaries there. But that, if you don't see an LPAC, you need to question why there's not one. So I'll keep heading over to Adam.
No, all good. Adam, thoughts?
Look, I mean, largely aligned to. I was making notes and then crossing them out as Kieran was speaking.
Sorry.
I mean, my first point that I was going to make was beware of the unintended risks, because you've really got to understand them. I think Kieran articulated that quite well. You made the point that you think it's worth it. We absolutely think it's worth it. PE has outperformed reasonably consistently. It doesn't always outperform over the short term, as we've seen recently when we've had listed equities running hot, and private equity has been sort of left behind to some extent. But that's okay. Nobody has all of their eggs in one basket. Nobody has all of their assets allocated to PE. So while listed equities are running so hard, it's not a tragedy that your private assets would be lagging behind. And my last point is be diversified. Don't try and pick winners. You can always get, things wrong. You don't want to be exposed to a single vintage, a single region, a single strategy. There are niches that perform well, and they can be included in a portfolio. But what you want is to be diversified to capture the enhanced risk-adjusted returns that the sector offers on average. If you are too concentrated, you're exposing yourself. Yes, you may outperform, but you're exposing yourself to significantly more risk than those risk-adjusted returns across the industry would indicate.
Yeah. No, I think that's good advice. Thanks, Adam. So hopefully everybody got a little bit out of that. We probably got through about 5% of the questions that we discussed. We may actually put out there. So it is a very big beast, the whole private equity space, and you keep digging, and there's just more and more details to go through and scenarios. So, but hopefully we did cover some interesting topics. So thank you, Kieran. Thank you to Adam for your time and presentations, and I think the discussion was really hopefully quite thought-provoking. So Toby, back to you to wrap up.
Great. Look, thank you very much. And I got a lot out of today's session. It's a delight for me to have the opportunity to have three people who are so deeply knowledgeable and actively engaged in this space, to have to make their time available to talk with us about the way they think about private equity and the opportunities and risks that it gives rise to. Jason, thank you very much for your participation over the last 3 days. We've straddled a lot of territory from emerging markets to SMIDs, from listed infrastructure to Japan. I'm sold on all of them. I've listened to those managers and they've all got my no. It's been a really interesting opportunity to look at the ways in which the growth component of portfolios can be built in really very interesting ways for each type of client. So for those of you who've attended, thanks very much for your time through this week, and we look forward to you joining us in October at Independent Thought in Melbourne on the 8th and Sydney on the 15th. Thanks very much. Kieran, Adam, thank you.
Thank you so much. And thank you, Jason. That was great. Thank you. Thanks, Adam.
Thanks, guys.
Well moderated, Kieran. Always a pleasure. Thank you, Toby.
See you. Bye.